So in the last 48 hours, probably a lot of you missed my previous memo. Crypto recovered 14 to 15% versus the gold and the silver only 1.3%. Why is this? Well, like I said, if you missed the memo, you probably wonder why. Let me explain. In the last 48 hours, we had over $310 billion that was essentially bought off the tip on the crypto market, which inverted the patterns, and now the market will liquidate around $2 trillion in short positions. But why the gold and the silver didn't move? Why the recovery didn't appear the same way on gold and silver, where they're much cheaper? The gold is cheaper, the silver is cheaper. It was even greater dip earlier prior on the silver, around 40%. So this means that the people who are more bullish, people who are always bullish on precious metals as a safe haven, they didn't buy the dip this time. Why? Two possible scenarios. They either run out of money or they're extremely already concentrated in precious metals, meaning, we can speak whatever you want for diversification, for hedging, but you cannot just simply hold one or two separate assets. You need to have a very diversified portfolio, considering that the market is not yet decided. Are we going to go into the recession, or are we actually going to persevere? Pay very close attention to the numbers. And these numbers are already in the past, so this already happens. We're not speculating, okay? So in the last 48 hours, we had a sharp intraday recovery from the sharp dip in the crypto markets. Very importantly over here is that the strong rebound on the crypto market appear only on the crypto market. Sure, the stock market is closed on the weekend, but remember, the futures market is open. This also indicates that on Monday morning, the gold and silver will have a chance to recoup the losses. Remember, I was talking about yesterday the levels of 5100 in gold. If the gold doesn't break the 5100 throughout the next trading week, well, gold most likely will be in trouble. And if the gold is in trouble, we don't really worry about silver, because silver will fall even more. The net recovery window, look at what is happening on the crypto market, was between 14 to 15%. And remember, people were calling out the end of crypto, the beginning of the cold bear cycle of crypto, which is not happening, because I mentioned last week that the 4-year cycle for crypto is no longer a thing. People are no longer following it because the Bitcoin and overall crypto market cap has become mainstream. You see Fidelity, you see Schwab, you see banks are offering clients to actually buy or invest in crypto. You also see the biggest asset managers, right, buying into the ETFs, Ethereum ETF, Bitcoin ETF, Solana ETF, AVAX ETF, right? This is very, very important. The current levels for the crypto recovery hover around 2.3 and 2.4 trillion dollars. It's very important because all these monies, as you probably understand, this is not the average Joe is buying the dip. This is institutional investors. This is Wall Street. So why Wall Street, instead of buying the silver dip, which if the biggest gap down 40%, if you're bullish, there's potential biggest gap up if you believe that it will go back up again. But they're not betting on this. Wonder why, right? Same thing with the gold, right? Why they're not betting that the gold will go back up, or why they don't hold on the previous price target, it's $10,000 by the year end. If we believe, think about it, if the gold now is around 5,000, 4,800, 600, but if you truly believe that the gold will go 10,000 by the year end, you're looking at crazy percentage upside. And if you truly believe, why Wall Street is not buying it? Because the likelihood of Bitcoin surpassing the previous all-time high are much lower, right? How likely is Bitcoin to surpass 121,000 in doubles to 240,000 versus the easiest goal for gold just to make it double from 5,000 to 10,000? It's much easier. But people are not betting on the easier part. People are betting on the more hard and complicated part, going from 70,000 Bitcoin, 72,000 to back to previous all-time high at 121,000, and then doubles to 250,000. Remember, Tom Lee from Fundstrat still holds his price target for this year between 240,000 and 250,000. We're not talking about Ethereum. I'm kind of bearish on Ethereum, so we're not gonna focus on this. Now let's look at the recovery process in the gold market. Let's look at the spot gold. So the experience dip that we saw on February 6th, which effectively was on Friday, hit lows of 4,600, lows of 4,600 as well. Very important is that the recovery was not that big, it was around 3 to 6%, but this particular dip, right, was not something that a lot of people were waiting to buy into. There was no interest, right? If you look at the charts, we saw that there were a couple of green candles, but there was more than red ones. And we saw that we failed to break the previous highs, or at least to reach the previous highs. Remember what I mentioned? If we couldn't hit the previous highs going up, make a lower high from the previous high, the likelihood is that we're gonna go lower. And next time when it goes up, it's gonna go even lower than the previous high, and then it's gonna go lower high, lower low. This is what Wall Street expects. And if they see this weakness, like I said, gold has next week to break the 5100. If it doesn't, most likely the Wall Street will set up the computers and the alternative trading systems, ATS, the computer trading, the algorithm trading, to most likely flush the prices. Remember, there are a couple of important levels of support that you want to look at: the gold 41, 4200, and then if it goes below that, we're looking at 3800, possibly 3400 if we're having a major, I would say, rotation. This is a very important term on the markets. So we didn't see the recovery that people were expecting. We didn't see people buying the dip as we expected. And if we move to silver, things are looking a little more uglier. Lower interest, right? Spot prices, again, much lower, greater dips. We saw 7 and 10% sell-off on the silver market, but the reversal was not there. Lower volatility, lower interest, 48 hours recovery was partial, very partial performance, similar to the crypto markets, but with a lower volume, much less lower leverage positions, which, as you're probably aware, when you see a lot of leverage, this means individual investors, because they place a small capital, right, and they borrow against a small capital so they can have larger positions, so they will be able to capitalize on the small price moves. Big investors, they don't use leverage, they just have a lot of capital that they can operate with, because it is expensive to borrow. And remember, when you borrow, when you trade on leverage, a small moves, sometimes 0.5% can liquidate you. I'm talking about absolutely everything to go bust. This is why when you're big institutional investors, you want to make sure you have room for mistakes, you have room for errors. So if the market goes against you, you're not going to lose your investors' funds. Where individual investors, right, they don't have much to lose, especially if they trade with some international overseas brokers where they allow them 100x, 500x, crazy leverage. Don't do this at home, kids. So that's what I'm seeing over here. We're having a sharp reversal on the crypto market, and again, seems like the worst is already in the past. I don't know why there is a slowdown on the precious metals market, considering the negative beta I've been talking about. So a lot of people saw that the main function for which they're buying gold and silver doesn't function. It's no longer hedge. It's no longer negative beta. When the market crashes, gold and silver crash as well. So why would I buy gold and silver when they crash as well, and they crash even harder? If I had S&P 500 on Friday sell-off, I will be down 1.7%. If I had the gold, I will be down 8%. If I had the silver, I will be down 12 to 15%, right? What's the point? There's no point. Also, let's not talk about how illiquid some of these spots could be, and let's not talk about how the volatility disappears overnight sometimes. When the market decides that, you know what, they don't actually fulfill the need I had for hedging. So be very, very careful